LUBAs. And in most cases, you would say, well, we should go with the least expensive one. And that may be what this committee and the board chooses to do, but I would like to explain to you why the second option may actually be the better value over a period of time. So many of us are accustomed to what dividends are, and of course in the insurance world you have LUBA, workers' comp. It is a mutual company, which means it's owned by its policyholders, and it does have a dividend, and we have earned dividends in the past. And if we had a tough loss year, it might be as low as $70 on our premium size, and the best has been just a little bit north of $10,000, okay? With LUBA, it's not just dependent on the company having a good year, it is dependent upon the policyholder, which in this case is the board, having a good year. And if we have a tougher loss year with the LUBA model of dividend payment, the board might not even qualify for any dividend at all. With LWCC, its dividend structure is different. When you start, it is a very modest dividend because it is basically a model of loyalty, policyholder loyalty. And so it increases based on their past 20 years, it increases each year up until year 5, at which point you meet the maximum possible dividend. Unlike LUBA, it is not based on our profitability. We could actually have a terrible loss year and still earn a dividend, which is unique in the insurance industry because I know of no other insurer who does that. Most all of the time, no insurer is going to give you money back if they lost money with you that year. So you might say, well, why would you ask us to entertain a higher premium? Well, if we were to go with the LWCC option, the first 2 years, there's no way around the fact that it would be more expensive, even with the anticipated dividends that LWCC has modeled for us. But in year 3, it starts to step up so that it's significant enough that at that time, we would actually be at a break-even point. We wouldn't be ahead, or if we're ahead, not by a lot, but we would be back to a break-even point for the entire 3 years. But in year 4 and in year 5, based on our last 6 years of loss history, the model that they have given us shows that we could earn a dividend of up to $400,000 a year, which is significant. So while the premium might be higher, the net cost of risk after the board finally gets through, I've told Nisha the first couple of years are years of pain, right? We're paying a little bit more. Year 3, we break even. Year 4, we start reaping savings. And then in year 5 and beyond, I really believe the board would be very glad with making the change. But there's no easy way to get there. We can't have it. We will not have immediate gratification. So with me, I'm thinking about the years that may exceed all of us in this horseshoe, me, whatever. Eventually, when you get through those first 3 years and start reaping the rewards, it can be quite significant. Dividends are not guaranteed, right? So dividends are dependent on, with each company, of the board of directors making a declaration of dividends. But both companies for the past 10 years, past 20 years have consistently. In fact, in the year of COVID, LWCC did something quite unusual in that they paid 2 dividends. And so you can imagine at that point what that could amount to. And you may say, well, why are we just now considering them? Well, it's a very easy answer. We had some issues that on larger accounts, you have to have a long-term look, just like we have with LUBA. As you know, I brought you pretty much stable premiums for a long time, and some of those years, LUBA lost money on us. Some of those years, LUBA made a lot of money on us, but they got that we needed this to be a budgetable expense and not look like a heartbeat so that we're in cardiac arrest from year to year, budgeting $500,000 one year and $1.5 million the next. And I would tell you that the new underwriting leadership, or relatively new underwriting leadership, I've had extensive conversations with, and they have assured me that they are interested in a long-term look. So with that, the rest of this just shows you what our experience modifier is on page 3. It shows the natural progression of payroll that we have and what the payrolls are based on. Both companies have good ratings. And then on page 4, I've basically shown you the few self-insured or the 2 self-insured claims from prior years that are still open. But if the board can have confidence in my recommendation in this committee, if we can trust the process to get past years 1, 2, and 3, I believe in years 4 and 5, you will be very glad with the change that I'm recommending. However, whatever you decide, we still have 2 good viable options from 2 good insurers, both of whom very much want the board's business, obviously. And so I would be glad to entertain any questions and explain my rationale for that. Ultimately, my recommendation, based on conversations with Ms. Bamberg and Mr. Rowland, and our insurance committee chair and I have visited about this, would be to accept the LWCC option.
Mr. Faulting?
Thank you, Chairman Bertrand. If I'm reading this right, is this essentially saying $83,000 at net cost of risk? So $83,000 over 3 years is $249,000. So in essence, are we paying $249,000 to possibly, which you said was not guaranteed, get 400, which would be basically a net of 151?
Well, I've done the math, and I realize I didn't put all of my calculations on here because I knew we had a finite amount of time, but it's a very astute question. So years 1 and 2, we pay more to go with LWCC overall, even with what we would anticipate the dividends to be. LWCC could break their model and not declare a dividend, but it would be a break with their corporate ethos because unlike other companies, they're a nonprofit organization. They are uniquely set up. And so there is nothing for them to do with their money but to return it to the policyholders. Year 3, even considering the additional cost at that time, the dividend projection is we would recoup all of the higher payment in the first 2 years, plus the 3rd year, and be basically back to break even or possibly more. At year 4, that's when it really steps in where we could save hundreds of thousands a year.
So if we stayed with LUBA and we're $83,000 to the better each year at, 5 years, that's $415,000 that we're saving already. We're not having to risk or gamble. I just think it's an awful huge risk to gamble for us maybe or maybe not to get it when we can just immediately not have it. Does that make sense what I'm saying? Like, I don't understand.
Everything is, and the great point is, to your point, so let's say that we did spend the $400,000 more. In that 4th year or 5th year, that could be our savings in just 1 year. And it's true, you can't, a bird in the hand is better than 2 in the bush. We all know that.
Right.
But for LWCC to break its model, there are probably some policy holders here. If all of a sudden their dividend disappeared, their entire business model would disappear, and it would suggest at that point we probably would want to move away from LWCC, but they have been very consistent.
But we don't have any way to know what those dividends would be. What if it's only $20,000 a year for dividends?
Well, see, that's a great point. The good news is they're the ones that actually gave us the projection.
Right.
And I think I noted in here that we would anticipate the dividend in year 5 being $470,000. And what they're doing is they're not basing that on wish. They're basing it on what our previous loss history was, which helps them price the premium.
Right.
And then what our dividend would be based on the premiums paid.
So essentially, year 4 and 5 at $470,000, if we stay with LUBA and save the $415,000, it's essentially only netting us $55,000. And that's a gamble that we don't know.
And that's year 5. Year 4, we're actually going to get ahead. So
Right.
in year 4, I believe the calculation was it would be like a $380,000 dividend. So you won't quite recapture everything in year 4. Well, you will, because in year 3 is when we anticipate you getting back to even. Year 4, you would actually get ahead. In year 5, that's when you reach the maximum dividend tier.
Well, and so leads me to my next question. Why would we switch now? Why would we not save the money now and possibly look at options later on down the line that may not have to have a 5-year return on investment?
That's an important question too, and the reason why I'm recommending it now is because every year we pass, we push the 5-year threshold down the road. And so it's almost like they tell you with exercise, the later you start, the harder it is to have improvement. Well, here, there's no other insurer that offers anything close to this. There's no option 3, 4, or 5 that's going to do this. It's going to pretty much be a model between LUBA and LWCC. So for me, either option is a good option. The board is going to reap most of the benefits of this later on. My obligation is to bring you this as an option so that you understand that if we do make an investment, this is just like making an investment.
Right.
You invest in a business, you might not make money the first year. You might lose money the first year and the second year and even the third year. But if you really have promise that, hey, in year 3, I think we can make a turn and have all our money back, and in year 4 and 5, really have a great return on our investment. This is kind of the same thing because it's a loyalty dividend.
But year 4 and 5, would that be potentially a return on investment?
Everything is potential.
Right, okay. And I'm not trying to question it. Just
everything.
My business mind is not, this doesn't add up to me, and I'm just trying to understand that.
This is an
that's all.
investment today to pay more to save in the future. And it's just a question of, do we have the political interest in that? Are we willing to invest in that in order to gain more later? And of course, that's what you all are elected to make that decision. But what we felt is there was no way we could not offer this to the board because of the potential reduction of our overall cost of risk.
Right, and as it sits now, we'd be $83,000 ahead every year that we don't, like if we don't use the LWCC. So in 5 years, we're, again, $415,000, 6 years, we're almost $500,000, which is savings, which is not a potential, that's concrete. I guess now the insurance laws, as often as they change, and rates as often as they change, couldn't this LWCC by years 3 and 4, couldn't that totally completely be revamped, and
It
be
could, for
potentially,
instance, on our property insurance.
right?
We're making a decision to stay with insurers based on what we're thinking should pay in the long term. We went through a $15 million claim and they stayed with us. We want to stay with them. If we have another $15 million claim next year, is it possible that they then would say, we love y'all, but we've had all the fun we can take? Here, it's possible our loss history could change. We could become a terrible risk overnight, at which point LUBA might decide they don't even want our business. The good news about LWCC is they are the market of last resort in Louisiana, so they have to price it. These premium illustrations I'm giving you is based on us averaging what our experience has been over a period of time. But of course, it's not guaranteed that we're going to continue our level of profitability. A perfect example of that is if, let's say, we turn into a demolition derby and our losses are $2 million for the next 2 years, well, then I can promise you I'm not going to be bringing you any premiums that are at this level. But the great news about LWCC is, again, they've paid these dividends consistently for 20 years. All you can do in judging a person or a company is try to look at what they've done in the past.
Right.
No guarantee of the future. But the great news is, even if we burn them up in year 5, they still pay us the dividend. And that's the unique X factor in this option.
Yeah.
Mr. Wiggins?
Ms. Farley, are you done?
Yeah, I'm done.
Ms. Farley made some good points, and we need questions about everything. However, I've been on this committee for a number of years, chairman sometimes, and Mr. Rogers' track record is strong. He's never led us wrong.
Oh.
I believe his experience counts. And therefore, although there are some questions there, I believe if we follow his recommendations, we'll come out just fine, and it always has. He's never let us down. So therefore, I move that we approve the recommendation of Mr. Rogers on this particular insurance item.
Well, thank you, Mr. Wiggins, but I certainly want to entertain any other questions that anyone has, because I know this is a big decision.
Ms. Smith?
From a personal standpoint, our business has LWCC, and we've had it for, I know, at least 15 years since I've been doing the books, Eric, and we do get the reimbursement from the dividends every year, and it equates to 60 to 80% of what I pay in every year that we get back. And they did do the extra in COVID, where I think it even exceeded what my premiums were actually during the year of COVID. I'd have to go back and look at the exact number. But I do think that in the long run that it would be cost savings, because after you get past year 4, you would recoup all of that you're doing, and then from there, it would just be lenient minus the 80,000. So, but they have been good to work with. They do have good customer service and are timely, and with our experience modifier and everything, it does help, and they are a strong company, so.
And it's important, one of the things I should have said that you may be considering, and I'll let Ms. Bamberg speak for herself, but we were sensitive to, will the budget support this, right? Because we set budget expectations based on what it is, and it's important to remember that both of these expenses are in 2 different fiscal years. And Ms. Bamberg, I believe you said this would be within budget that doesn't require an amendment, and I apologize for not mentioning that early, because I know that's a consideration.
Mr. Bullard?
Thank you, Mr. Chairman. Mr. Rogers, when we went to Luba several years ago, one of the big sales factors was the support they provided to us in terms of risk assessment, and they would come on site, work with our people. And I believe in your reports to us over the years, we have reaped some benefits from that, particularly in terms of claims or incidents. What is your understanding of the support service that LWCC would provide? Would they give us the same service?
Excellent question, and thank you for making that remark. I don't have my notes in front of me, but if memory serves correct, the last year we were in qualified self-insurance, I believe our losses were $1.2 million just for that one year. And our experiment, thankfully, has worked. Our losses are about half of what they used to be, and sometimes better. Now, we do have some years where our losses are right at $1 million. It happens, but I don't want to disparage anyone for sure. As you would guess, we have had some disruptions in this relationship recently. There has been some turnover. Our loss control representative changed, and it has been a challenge at times and has required a fair amount of Ms. Bamberg's and my time, but that's okay. We're willing to put whatever time we need to in it. We have had some claim hiccups that she basically had to clean up, and we, in my judgment, are not receiving the level of service that we did before. It's still good. It's still favorable if this board chooses to stay with them. We have addressed it at the highest levels with LUBA, We have a plan to try to recover. It's not all fixed yet. We're still working on it, but I'll give you that background. With LWCC, whenever you date somebody new, there's always a possibility that you're going to have some adjustments as you get into it. But I can tell you, sitting around the table with their entire leadership team, they have assured me they understand the approach to underwriting large accounts, and they do write some accounts that are far larger than Bossier Parish School Board. They know that we're doing what's right from a loss control point of view. They understand the commitment of this board, the administration. They are going, if the board chooses, I didn't want to be presumptuous, so I did not have them come up here to meet anybody yet. I've done the meeting so that I could be assured, because my name is on this recommendation. But they're sending up their team. We would have the same dedicated adjuster for indemnity claims, for medical-only claims. They're going to send us their best loss control specialist. We've talked about we didn't need somebody who was trying to prove all that he knows, and someone who understands the reality of public buildings and school operations. And we were equally concerned about the audit side, because we need audits to be easy for Ms. Bamberg, and they've committed that they will not send a third party, that they will send one of their employees to do that. So we'll find out, Mr. Bullard, how it's really going to work when we go down that road. We could have some bumps and bruises, but I've received, if they gave me many more assurances, I would almost be doubtful, because they were overselling. Good question.
Thank you, Mr. Chairman.
Mr. Faulting.
My last statement, and then I'll drop it, because, and I know LWCC is a great company. I think for those of us that will be here in 5 years, I just would have a problem using taxpayer money on a potential, in 5 years, you said it would potentially, doing the math, of $55,000. That's a gamble, and if for some reason it doesn't, how are we going to look at the taxpayers and say, yeah, we used your money, pay more in workman's comp for the same coverage on a risk, and it didn't go through? And I just don't think we should do that.
Yes, sir, and I respect that concern. It's almost like building. You can build to the cheapest standard, or you can invest more, because the maintenance should be better. And what I'm suggesting, based on 20 years of performance, is I believe we will spend more to build the building initially, and I think we will reap the benefit that will actually make the cost lower over the long term. And of course, I've got a lot riding on this, and so I would never make this recommendation unless I had a very high level of assurance that it would be a good decision, because I know if it doesn't work out well, you will be asking me why. And I'm very acutely aware of that accountability. Yes, sir.
We have a motion by Mr. Wiggins. We hear a second. We have a second by Mr. Bullard. All in favor, please vote. Raise your hand. Motion passes.
Thank you, and we'll work hard to make it a good experiment.
Agenda item 3, request approval of life insurance renewal for 2025-2026, presented by Mr. Jason Ullman, Ullman Group, Inc.
Can I get you to pull up the presentation? Thank you. This is the renewal for the life insurance, the group life insurance. The members actually pay 80% of the cost, and the retirees pay all the cost of it, but it's a group benefit. The employees get a $10,000 benefit, and the retirees have a $5,000 benefit. If you can page forward to the history, we've been with Symetra now for since 2014, so 11 years. First 9 years, we didn't have an increase. They increased the rate in 2023 for a 2-year rate guarantee. Again, it's a $10,000 benefit with the $5,000 on dependents as well as on retirees. You can see how much the employee pays for the coverage on this presentation. Again, it winds up being about 85% of it. The active employees can buy up to 5 times salary, up to a max of $500,000. As a new employee, they have a guarantee issue amount of $300,000 they can buy. A spouse they can purchase up to $100,000, and on children up to $10,000. It's a group supplemental. Right now, the plan carries about $374 million worth of death benefit for the employees, either through group or through supplemental. Again, Symetra's been the carrier since 2014. We got a 15% increase in 23. Prior to going with Symetra, the carrier that we had previously was wanting to go up 53% March 1st, 2014. I've had this renewal extended, the current rates until 5/1, to give us an opportunity to make any changes that we needed to make. Can you page forward? So this is the claims experience over the past 10 years, and what we're looking at is through December of 2024, the plan actually has paid $7.7 million and paid out $8.8 million worth of claims. Of course, that's not what an insurance company would like to have, but I was able to negotiate a deal with one of the carriers, and the main focus, you can look at 2021. 2021, we paid $648,000 of premium and had $2 million worth of claims. That was a COVID year. It was an anomaly. We had a lot more voluntary claims, supplemental claims than what we would normally have. If you can see the string of years, it's pretty constant otherwise. But in the end, it's still 110% loss ratio over the string of 14 years. Page forward, please. So we went out to, go back one. So we went out to bid, we got the renewal. Initially, the renewal with Symetra was higher. I was able to get them down to 14.95% after negotiating with them and discussing the anomaly year, but they still were at a loss. MetLife actually came in at current rates, or 0.31% over current rates. It does give us a 40-month guarantee. They also include a modified open enrollment where current members or members that aren't enrolled today that were eligible in the past could buy up to one-time salary up to the maximum cap of the $300,000 guarantee issue amount. But it'll give some people an opportunity, if they've worked here for a while, and not have to prove medical evidence, to buy some additional insurance as long as they're actively at work. Okay. The other carrier that did offer a quote, other two carriers were Standard Life. It's a 9.5% increase. They would do a full guarantee issue open enrollment, so everybody could have access to the max of $300,000. And Voya was 17.87%. You can see the number of declines that were received. I think we have a very competitive rate. If we look at it, turn to the next page. If we look at it, all the way back to when we were with Reliance Standard from 2010 to 2014, our rates have been lower than those rates for the last 11 years. And if we take the deal with MetLife, they'll be lower than that for the next 4 years. So MetLife is a national company. It's a competitive offer. I think it's a good offer. We've went through all of the contingencies. I would work with Nisha to make sure that they match all the requirements inside the contract and we don't leave any gaps as far as, and also make sure that we make sure everybody that is not actively at work today would be continued either through the current carrier or through the existing carrier through waiver of premium. You can turn to the next page. The difference in premium from the renewal with Symetra and the offer from MetLife is about $115,000 a year. If you strung that over the 4-year, 40-month guarantee, it's approaching $400,000 over that period of time. The Symetra renewal is only a 2-year rate guarantee. Y'all have any questions on that? Does it need to go back?
Comment?
Chairman.
Mr. Wiggins?
Ms. Albert, I spoke about this earlier. I understand why, but it's not fair to the retirees. When a retiree turns 70 years of age, the premium, the payout drops from $10,000 to $5,000. You need it later on. For employees, they can have whatever, I guess, insurance they choose. The answer is not available right now, but I will be working hopefully with some other board members for the people that built this city, the retirees that made it what it is now. They should be able to keep whatever insurance they had while they were working once they retire. Now when they get 70, it drops from 10 to 5. That's not right. So we can't make it corrected now, but we'll be talking about it in the future to make that right for our retirees who gave their all.
And I
It's
appreciate
my
that,
comment.
Mr.
Thank you.
Wiggins. Excuse me, I appreciate that, Mr. Wiggins. And as I tried to point out earlier, and I just want to make sure that we understand this, when we look at the retiree basic life, right now it's a pool rated amount, right? It's a set 64 cents per $1,000 worth of group benefit, 64 cents per thousand, whether it's active or retirees. The retirees, once they get to it, it's a claim eventually. The vast majority of the claims that are filed are on the retirees. The $5,000 that a retiree gets it has no age reduction. So no matter how long they live or whatever, it's a $5,000 benefit. If we were to take, and what all the carriers wanted to do was separate the retirees from the actives. The retirees premium, if you can look at the far corner of this, Voya had their rate, one rate for active employees, which dropped the active employee rate by 64%, and then one rate for retirees. And to separate the retirees from the actives, the rate would go up 445%. Okay? So to buy additional life insurance for the retirees, we may be in a situation where nobody wants to do it because that's where all the claims are coming from, the vast majority of the group claims. Now, when we had the situation with COVID in 2021, it was a lot different because you had a lot of active people that actually passed away. You had a lot of supplemental premium. That's what made the loss ratio so much different. And we can look
I'm
at
not
it.
blaming or
We'll work
criticizing
towards
you,
it.
I understand.
Yeah.
It's all about the money. I'm just saying it's not right.
Yes, sir.
And we have to set it correct. The ones who made us who got us where we are, we shouldn't drop them once they're no longer employable. It's not right.
And at one point it was,
But there's a way. We'll get it done.
they had two benefits. It was a $2,500 benefit for 2010 or a $5,000 benefit. And we had everybody move to the $5,000 benefit.
Thank you. Thank you, Mr.
Any other questions, concerns?
If you can turn to the next page, my recommendation is to accept the offer from MetLife and move forward with the 40-month guarantee at the same rates.
We have a motion by Mr. Faulting, a second by Ms. Poole. All in favor, please vote by raising your hand. Motion
Thank you
passes.
very much.
This time, this completes the Insurance Committee meeting. Meeting is now adjourned.
Presentation of the financial and single audit report for the Bossier Parish School Board and the AUP report for the Bossier Educational Excellence Fund presented by Alan Green Williamson.
Good evening. My name's Amy Tynes. I'm with the audit firm Allen Green & Williamson. I'm an audit manager responsible for the Bossier Parish School Board's audit. I do have with me Mr. Tim Green. He is our managing partner for the firm. So if you have any questions as we go through, please feel free to stop and ask. I will be only going through the high points of the report. I do apologize in advance, though. After the meeting, I do have to pick up the reports. Even though the legislative auditor has approved the report that was issued, they have not issued the report, and we're not allowed to issue it or give it to anyone until they actually approve it. So we are still, issue it. So we are still waiting on that. You have two reports with you. The one